Well, and it kind of stars and dogs or a tale of two fashion retailers. I'm going to start with the star, and that would be Group Dynamite, symbol GRGD on the Toronto Stock Exchange, trading around $40 today, market cap 4.3 billion. Montreal-based women's fashion design house and retailer, been around since 1975. Operates two distinct brands, Garage and Dynamite. Garage is where the real growth of this business is. The company offers a wide range of women's apparel through retail stores and digital platforms, focused on innovation and disciplined execution. They operate close to 300 stores in North America. More than 70% are under the Garage brand. They plan to enter the UK market in 2026, projecting 10 stores by 2028. Well, this is, again, that nearly 200% gain that we've seen in the stock just over the past 6 months. What is driving that? Well, I mean, the Q2 results will be out this week, but the Q1 results were strong. Revenue was up 20%. Comparable same-store sales growth was up 13%. That is significant growth. Adjusted EBITDA up around 20%. And diluted net earnings came in at 24 cents per share compared to 22 cents in the same period of the prior year. The outlook now for Q2, this is the consensus outlook from Analysts, about 42 to 46 cents, average is 43. They're reporting midweek this week, so September 10th is when the numbers come out. The same store sales increase there is 9.7%. That's slightly above the high end of the revised annual guidance from the company, 7.5 to 9%. So the market is expecting them to beat those numbers, reflecting a strong start to the year. First half of the year was around 14%. That should normalize. There is some tariff impact here, normalizing the second half of the year to about 6% same store sales growth. That is, again, due to that uncertainty around tariffs. Consumer spending as well impacts the company. Now, valuations certainly higher on a forward-looking basis than we originally recommended. It was in the 12 and a half, got down to about 9 after the Liberation Day announcements. About on an EV to adjusted EBITDA basis, around 11 times in that range. So conclusion here, just quickly, our star, solid growth story with longer term runway in the North America, particularly growth in the US, a well-defined target market, sector leading organic driven top line growth, disciplined and data driven approach to design and inventory management, clearly articulated real estate premiumization strategy going to higher end retail, and good free cash flow conversion, strong balance sheet, potential to implement a dividend over the next year. It's something that we think may happen over that time period, and forecasted mid-teens top line compound annual growth over the next 3 to 5 years potential. So that is our star of the week. The main holding here for Keystone and our clients is still Group Dynamite. The company has done tremendously well this year, trades around in the fair value end of its range right now.
It really shows the two different stories. You have Group Dynamite, they're raising their comparable store growth with the last quarter. Mind you, there's a bit of lag here, so they're obviously reporting in a couple of days, so we'll see if that holds or not. But they did report after the whole tariff tantrum. So likely that, in my opinion, that is going to hold. And then on the other hand, you do have Lulu. They're dropping their guidance. So you have these two very, very different. Group Dynamite is about half American as well. So it's not like it's apples to oranges geographically. And it's their American stores are actually doing better than the Canadian in general.
Yeah.
So it's really just two different scenarios of growth and in the same economy. Yeah. And it can be just one of these shifts of really brand identity now. Is Lulu just becoming out of favor? And we've seen that before in fashion, time again.
I did note that, in the last 6 months to a year, Brennan has been buying Lululemon. So, I mean, I think that's your negative or reverse indicator on the sector. As soon as you see, somebody from Saskatoon buying Lululemon or your brand, it is done. it's over. So maybe Lululemon. I'm just kidding, but but no, but fashion is fickle. It is a hard sector to project because I mean Lululemon can still make the same quality clothes, and if the market or the its target market says what this is out, your brand is out at this point, then it's very difficult. Then suddenly you don't have a premium multiple and you go from like having a 30 times earnings to now 12, 15 times forward. And, it can really destroy the stock, at least in the near term. Perhaps it's an opportunity if Lululemon gets back on track. I mean, it is an iconic brand. Their clothing is fairly well thought of, in terms of its target market, and they have had a cult following in the past, but certainly it shows you. I mean, the multiples earlier this year, you would have been trading at 30 plus times, and you would have that's why we're looking at that. We think it's a great company. We don't want to pay any price for it. And then you look at Group Dynamite earlier this year. We think it's a good company, but we were paying 12 and a half times or under. And, with more growth in terms of same store sales projected and at the time. So that's why, you look at a company, Group Dynamite, Lululemon, iconic brand, very well run company, but which is the better buy in the market at that time? And for the course of the first 6 months of this year, certainly it's been Group Dynamite, but we'll see how on track those companies going forward. It is a tale of two markets in the financial retail market in Canada. You look at like Canada Goose suffering over the past several years, but you look at Aritzia. It's gone from the past 6 years, like the $16-15 range up to 80-85. So, I mean, the market will reward you if your same store sales growth is good, your profitability is good, and your revenue growth is good. And you've seen that with both Group Dynamite and Aritzia. And then on the flip side, you get punished in this segment if you have stumbles in those regards. So.